We are going to walk through each of the 5 worst performing markets, why they're struggling, what's driving the declines, and where the hidden opportunities are ultimately are. By the end, you'll know exactly which areas to avoid and which ones could give you negotiating power you've never had before. So let's get into it right away. So first off the hop, we're just going to have a little bit of a market overview for Greater Vancouver. So you can see here we have the average home price, benchmark price, and active listings. Average home price at 1.242 million, down 3% annually and 2.5% month over month. The benchmark pricing sitting at 1.165 million, which is down 2.7% yearly and 0.7% month to month. And then when we look at active listings, I mean, this is what is really fueling all the pricing and this correction. Over 17,000 listings, 20% higher than July of last year. And note here, in terms of Greater Vancouver real estate market is expecting its most challenging period since the early 2020s. The market is 7.5% below its all-time high of 1.259, which was in April 2022, indicating obviously a sustained correction rather than a temporary dip. Sales activity is down 2% year over year and 13.9% below the 10-year average. When we look at the worst performing markets here, and we have them on screen, a couple of them here are Fraser Valley. We do have Burnaby, which has seen this most severe decline in Greater Vancouver. This is overall at 12%. Fraser Valley condos, an annual decline, 5.8%, which is the steepest in the Fraser Valley Real Estate Board. And then the Fraser Valley detached market, a 5.1% drop and an annual decline of 0.5% as well. When we look at some of the luxury markets, which we know that the higher the price point that you have, the more distress and the harder it is to sell. And obviously your buyer pool is so much less. The West Vancouver luxury market down 39% and sales decline, severe market distress on there as well. And then I've highlighted this on previous videos as well. The downtown market in Vancouver continues to get crushed, 4.59% and an annual decline of 8% in terms of a June drop. So these markets are showing you some major areas where you can get some great value if you are a buyer. When we dive into Burnaby, which has the most severe decline, upwards of a 12% price drop overall. And you can see that with that, the price per square foot in Burnaby has dropped to $791, and that's per Yahoo Finance data, what real estate agents describe as a severe investor exodus. Obviously in Burnaby, Metrotown, Brentwood have been building like crazy. You can see all along Highway 1, the amount of towers that have been going up, continue to go up, and a lot of those have been rentals. And because the rental market has been because the rental market has been hit very, very hard in terms of softening of pricing, no longer being able to Airbnb, as well as the non-permanent residences and student visa issues, it has wiped out a huge majority of that rental pool. And that is a big reason why you're seeing all this inventory come to market in a lot of these urban cities. Downtown Vancouver's no different. That's why it's also on the list. And it's just softening. So primary causes, we just went over it a little bit before, but the massive investor retreat as they become unprofitable, they're not cash flowing. People are going in the hole quite a bit. And a lot of people who bought multiple units in these pre-sales are a lot of mom and pop type investors who just can't feel this burn for too long. They're very much overextended. Poor investment fundamentals due to the rising interest rates. Investors who bought during peak pricing facing significant losses, and then liquidity crisis as multiple investors exit simultaneously. Right here I have a note. Burnaby's market exemplifies what happens when speculative investment demand collapses. Years of investor-driven price appreciation have reversed as the fundamental economics of rental properties no longer work. As we get into some of the Fraser Valley areas here where there could be some opportunity for you, you can see that Fraser Valley condos, a 5.8% annual decline, monthly decline, 1.4% from July of 2025, benchmark pricing at $519,000, and inventory 50% higher than the 10-year average. and the average time to sell is between that 35 to 38 days. But again, this number here is not the true number. Agents will terminate, cancel listings, and then repopulate them to get a shorter runtime. But likely these are going to be well in advance of 100 days on market. When it goes to the Fraser Valley detached market, 5.1% annual decline, monthly decline of 0.5% from July. Benchmark price of 1.451 million and sales volume 23% below the 10-year average, firmly in buyer's market conditions. So if you are looking in the Fraser Valley, there are some nice corrections both in the condo market and the detached market. I know that a lot of people complain about pricing, but for those who are open to live in different areas, also who are open to be able to invest in some of these other areas that are outside Greater Vancouver, the Fraser Valley will have some great value for you, especially in and around that area just off 200th Street and Highway 1. They're building a ton of towers in there. They're all pretty much speculative for investment, and some of them now cannot sell whatsoever. You can be patient. You can pick up some really good property and get it for a very advantageous price point on a mortgage. I think no matter where you are, maybe if it's not your desired location, if you want to live in Vancouver, usually when you're climbing the real estate ladder, you try to get in as close to the city as possible. If what works is just in the Fraser Valley and you can get some good value now, get in there instead of renting. Purchase a condo if you're just starting to get out. If you're looking for a little bit more space, maybe a detached home, wait a couple years when the market will rebound and take that appreciation. And if you invest well, you can always take that money out and then buy a little bit closer to Vancouver. And then maybe from Langley, you can get into Coquitlam, then Coquitlam to Burnaby, then Burnaby Valley, finally to Vancouver. But think of real estate as a ladder. You don't need to be in a place where I need to live in Kitsilano right away, or I need to live in Mount Pleasant, and if I can't find a property in that area, I'm just going to rent. That is not good forward thinking. That's not a good use of your money. If you can get in somewhere rather than paying someone else's mortgage, you might as well pay your own. West Vancouver luxury market. So severe distress in the luxury segment. And you can see West Vancouver's luxury market is experiencing what industry professionals describe as a sucking wind, with dramatic declines in both sales volume and market confidence. Luxury sales over $5 million are down 39% region-wide. Ultra luxury sales above that $10 million mark are down 43% as well. Average luxury price down 7% to $6.6 million. So if you are in this space where you can afford in the luxury spaces, there's news articles coming out all the time in West Vancouver, even places in Point Grey, where you're having these massive price declines. Clearly, these sellers need to get out. And if you can't afford in some of these luxury segments, and you are patient, you can definitely get some good value out there. West Vancouver has traditionally been one of Canada's most expensive residential markets. The current distress represents a significant shift in luxury market dynamics, with both domestic and international high net worth buyers stepping back. With the economic uncertainty, even with Canadian politics, American politics, the tariffs, there's a lot of people who are not wanting to hold their money in BC and Vancouver anymore, unfortunately. But that does present a good opportunity for you, depending on which segment you're looking at. If you're watching this and wondering how these numbers may affect your buying and selling plans, don't just guess. Book a one-on-one discovery call with me. Use the QR code on the screen or the link in the description, and I'll walk you through the data to help you figure out your strategy moving forward. So let's go down to the next slide, and that is going to be downtown Vancouver condos. Oversupply crisis. You can see 78% increase in new apartment completions, 3,031 units as of June 2025 versus 1,698 in the year before. So we almost have a doubling of inventory and new inventory that has come to market, not to mention everybody who's trying to get out. Price decline, 4.59% annual decline, with 8% drops in June of 2025 versus June of 2024. And then the investor exodus, micro unit investments no longer profitable, many investors forfeiting deposits. And I unfortunately have been involved with some of these transactions where people have been forced to sell. They used equity from one property to put it on a pre-sale, and they just can't complete, and that forgoes your deposit. It is a very big deal, and that's why pre-sales, and there's such a risk to it. I have a trap video about why pre-sales can be a negative in this market right now. You have to be very careful, because for those who bought these pre-sales 2, 3, 4 years ago, when everyone thought property values in Vancouver are just going to continue to increase and increase. They never thought of a scenario where we would be in the market we're at. And if you lost your job or you couldn't bet on yourself to get to a certain income to make that mortgage, you will lose that deposit, and that can set you back years and years and years in your life. So the downtown condo market here represents the epicenter of Vancouver's housing speculation. Price per square foot has dropped to $1,206, down from $1,264. A 500 square foot condo that might rent for $2,500 a month cannot support mortgage payments on an $800,000 plus purchase price at current interest rates. And that's what we're seeing. Some of these units here in Vancouver, one bed, you could get well over $3,000 a month. They're starting to retract, $2,500 a month down to $2,000 a month. A lot of investors are so desperate to fill their vacancies, they're offering 1 month free or a new TV, something just to get people inside. When we look at key market drivers behind the declines, there's 4 things that I want to go through with you here. There's the investor exodus. Years of low interest rates encouraged massive investment in rental properties, and as interest rates rose and rental yields declined, these investments became unprofitable, triggering widespread selling. Not to mention just the interest rates. Property taxes have gone up. Strata fees continue to go up. If you bought in an older building, you may be slapped with some special levies. So investment, you have to be so careful. It may seem good in a hot market, but you have to really think long term if you're thinking of buying an investment in this market, because there is good opportunity. You have to think of what are things going to be like 5 years from now, 10 years from now. Can you really afford it? Oversupply in key segments. Downtown condos seeing a 78% increase in new completions. Micro units targeted at investors and luxury properties both face high inventory levels with reduced buyer pools. When we talk about some of these micro units, I have one for sale right now, under that 500 square foot mark. There's not a ton of them in and around the city, but there's a lot sitting. There's another building on Main and 2nd, and people are hamstrung in there. There's some units you can get under $400,000. They're listed, and they're not moving. These are under 500 square foot, low 400 square foot units. And again, at the time of development, people think that people are going to continue to move in here. Things can change. So you just need to really safeguard your investment and make sure that you have a proper plan of attack if things go a little bit sideways. Economic uncertainty, which we're all aware of, U.S.-Canada trade tensions, higher borrowing costs, job market uncertainty, and federal immigration curbs all are reducing demand and buyer confidence. Youth unemployment is at almost all-time high, something that we haven't seen since some of these recessionary markets, and that is very scary. The unemployment markers continue to move upward. I know the Bank of Canada today, when I was reading at time of recording, Tiff McAuliffe was speaking about how they need to do something with housing and how they can curb inflation with housing. So the Bank of Canada, not to get into a whole mortgage context here, but because one of the markers for the CPI is housing. So if the Bank of Canada does reduce their rates, they have control of reducing inflation as well. So it was interesting to see that comment today. Does that mean more rates are on the horizon? It's likely we're going to get one here coming up in September. But what does that look like coming up to the end of the year and into 2026? And then fundamental affordability crisis. Housing costs far exceed local income growth. Higher rates make properties unaffordable for many buyers, and younger generations remain priced out of the market. And, for me, pretty much 90-95% of my buyers, they're all getting family help. Either families have sold detached properties, downsized to help their kids, grandparents, inheritances, things of that nature. It's very, very rare right now for a couple or an individual to buy something on their own. With this correction, it is the best time that we've seen in 15 years or so to buy, but that still is preventing a lot of people getting into the market because the pricing is still so very high when you look at what people are making in terms of their salaries. When we have a little bit of a market outlook, I have 2 things here. The short term, 6 to 12 months, medium term, 1 to 2 years. So over the next 12 months, I do think, continued pressure with further declines. High inventory levels will take time to clear, and I think they're going to continue to build. Massive negotiating positions for purchasers and more realistic pricing as sellers adjust expectations. If you're a seller, so many sellers are tied to, this 2020 market. We just aren't there. If you are looking to sell, you need to understand that you're going to have some pain. I'm finding that, upwards of that. What I'm finding is when you're listing something around up to $1 million, maybe 1.5, whatever you think your home is worth, it's probably $50,000 to $100,000 less. And as you get above that 1.3, 1.5 marker, the divide becomes even more. So just really keep that in mind. If you want a home evaluation, if you are wanting a home evaluation, if this is something that you're thinking of, if you're thinking of upsizing, which is a perfect time for that, make sure you scan that QR code and we can get going on that as well. Medium term, price is likely to find support at more sustainable levels. I think this is more outside of the 2-year mark. Shift from investor to owner occupied driven market. I think the whole investment days with Vancouver, it's very hard to make that work. I think one side of investing that I think is very beneficial for people, especially young parents. It's something that I did. So I have 2 rental properties. I bought them essentially, they're right beside each other. They share the same alley, and it was for my kids. I knew I wanted to have kids. I got some pre-sales, and one of them cash flows maybe $100 a month, and the other one I am under by a pretty good margin, but about 80% of the costs are covered. And then I do in my home here have a rental suite. So when I take all those 3 suites, when I do take all 3 of those rental incomes, it does pay 100% plus more for my 2 rental properties. But I did that for one reason. I don't want to have to go enter into my retirement age, and when my kids are wanting to get into the market, and who knows, in 20 years from now, I don't want to have to pull out $1 million each to be able to get them into something. So by buying something, I did, this has been years ago, I know by the time they reach university age, both those condos are going to be paid off, and they're going to have something there for them where I don't have to take out of my retirement. So sometimes cash positive, it doesn't always have to be that way. There can be a strategy in how you want to play things, especially if you have kids, especially if you want to keep your kids close by. Finishing off, some areas may recover faster than others, and potential government interventions to support markets. So potential government interventions, I don't know exactly what they're going to do. I know some of the big developers are wanting some changes to the foreign buyer ban. We'll have to see what happens in the next 12 to 24 months. Long-term implications, these are not temporary blips, but fundamental market corrections that reflect years of unsustainable price growth and speculative excess. While painful for recent buyers and investors, these declines may ultimately restore some affordability and create a more sustainable housing market for the region. So I do think, over the next 24 months, pricing is probably still going to kind of tick downward. I don't think we're going to see this massive crash like so many people think, but if you are a buyer, we do have a soft landing space here for upwards of 24 months. So when we get into the key takeaways here, like I said, I just highlighted this. This is a correction, not a crash. 2 investor-heavy markets. So when we get to as we wrap a bow on this to get into the key takeaways, like I said, this is a correction, not a crash. The Greater Vancouver market is experiencing significant correction, with 5 markets showing particular severe distress. This represents a shift from speculative, investor-driven market to one more dependent on end-use demand. 2, investor-heavy markets hit hardest. This market most affected are those that saw the greatest speculative investment, suggesting a return to more rational pricing based on local economic fundamentals. 3, buyer's market emerging with inventory levels 20% higher than last year and sales below the 10-year average. Buyers have more options and negotiating power than at any point in recent years. And then 4, affordability will continue to improve. While painful for recent buyers, these declines may ultimately restore some affordability and create a more sustainable housing market for the region. I don't think it's going to get to a point where people want it to be, but it is going to be more affordable. And I think we're still going to see more of these micro drops here over the short and medium term. So with all that being said, this presents a massive opportunity if you know where to look. Don't let the moment pass you by. Hit the link, scan the QR code, and book your discovery call. And let's position you for a success in a market that most people are still trying to figure out. Thank you again for watching. I'll see you on the next one.